Welcome to B2B Synergy, the Power Partners USA podcast, your exclusive guide to discovering the potential of B2B partnerships. I'm Alan Armijo, owner of Power Partners USA, business-to-business introduction and referral service. Our members are B2B professionals who team up to provide each other repeat referral business or collaboration. Today, we are speaking to new Power Partner USA member, Jim Better, owner of Essential Plans of Insurance. Jim, welcome, especially to Power Partners USA as a new member. I know precious little about long-term care insurance and your associated insurances. Can you give us a background or understanding of your services?
Sure, Alan, and you're not alone in not understanding the mechanics and the need for planning for aging. My client base primarily is anybody who expects to age, and I work through business professionals who also don't completely understand what the needs are for people who, when they reach their retirement years. The fact is that, a lot of people will do a retirement plan, but no estate plan is complete without a funding mechanism for long-term care. Government statistics tell us that 70% of the population, that's 2/3 of the population, 2 out of 3 people are going to need help with their activities of daily living, which technically are being able to bathe without supervision or standby help, being able to eat properly, being able to dress properly, being able for continence issues, transfer, and cognitive impairment. Those are government regulation statistics that tell us that more than half of us are going to need help with those things as we age. Planning for that is really important. And I know that from my family experience. And I've been doing insurance for, I'll say many decades. But what really got my focus in the mid-90s, really, my mom, who had saved money that she had inherited from her grandmother, and she would tell my brother, sister, and I occasionally as we were growing up, when she passed, we would get that money. Well, it didn't work out. She got cancer, and she was in care for more than 3 years, and more than $400,000 got burned up in that care. That got my attention. I wondered, does anybody know about this? And that's when I decided, okay, the rest of my professional career was going to be to educate people on the need to plan for the cost of aging and to show them financial tools to deal with it.
Great. Thank you for that. The sounds like a horror story, is which I want to, maybe learn about as well, is like what people need to watch out for, what they're in for. But before we get there, and a lot of the other questions I want to ask, because we're targeted this audience to your Power Partners, can you explain who gives you, what business professionals give you repeat referral business?
Well, there are a number of sources, Alan. Certainly financial planners and estate planning attorneys are good sources for leads, because they understand that the need for planning in total, not just for legal documents, which are really necessary, of course, but that doesn't complete the cycle. So estate planners are important referral sources. Financial planners are important referral sources. Caregiver people, people who will help people move from, one source of care to another source of care, from home care to assisted living to nursing home care, wherever it may be. Those are the people who generally say, "Hey, Jim, I've got this client. She's 70 years old, and she has some money, but she doesn't want to see it all burn up in long-term care expenses. Can you do something for her?" And those are the people that generally need help with completing their clients' portfolios.
So you have estate planners, financial planners, and like home caregivers, right?
Home caregivers, nursing home people. The thing is, Alan, it's the person going into care. There are financial instruments that we can create that will help them if they're going into care. But really, the people who are the real target audience are the adult children of the people going into care. They've got their own children. They see what the cost of care is, and they are the ones who are really the target. They have all the options available to them. Their parents who need home care, their options are limited. So really the 40 to 50, 65-year-old people who have aging parents are the ones who are most likely to say, hey, look, I need some help here. And the financial planners and the caregiver institutions are the ones who would say, this is the guy you need to talk to.
Right. So when an estate planner, financial planner, they're talking with those people, right? So like when those conversations come up, they would think of you.
That's the point. And, all of our branding efforts since we moved to California 4.5 years ago is to promote ourselves as experts in the long-term care financing field. But I'll tell you the truth, Alan, I know a lot about it, but I'm really a student because I learn every day about how the instruments work and what people's needs are. And my focus is learning as much as I can to help my clients and my referral partners provide their clients with quality services.
Great. So when we're talking with, like I said, I'm learning about long-term care insurance and how it fits into everything. But what are some of the words or phrases or conditions that come up in like the course of conversation with somebody that would trigger the need for your services? What do people say, like at a, if they're talking within family or at a party or something? Not to break up the party, but.
Well, it's interesting that we've just come off of a Thanksgiving holiday where families spend a lot of time together. And there are aging parents who are part of those gatherings. And so what comes up in those conversations is, what's your plan, Mom, when you get older, when you need help? Do you have the legal documents in place? Those conversations are difficult to have. They're difficult to get started. And there are a lot of tools that you can use to get those conversations going. But I've already had a couple of conversations this morning with people who've come out of the family gatherings and says, hey, my mom wasn't able to be with us at the Thanksgiving dinner because she was in a nursing care, and we're all talking about how much that costs, and what can we do about that? We don't want that to put that same kind of burden on our children.
Would you say that, like with this sandwich generation, you have elder parents, but then you also have to worry about your own kids? The kind of conversations that are made, like let's take my family where like my mom's 80. I'm having that conversation with my brother. Let's say, like, how are we going to best help her, or what is she going to need? Because there's like, she's healthy at 80, but when she's older, like there's obviously a decline in mobility and things like that. At what point does a family have to say, like, this is when needs to kick in? When, what's the planning process for a family, let's say, so that they're ready when that time happens?
Well, there's an awful lot of things that go into that, Alan. What I encourage my clients to do when we've completed the process, and whenever we do a transaction for a long-term care insurance, one of my requirements is that their legal documents be in place. The will, of course, is necessary. Trust documents are necessary. Who's the power of attorney for medical? Who's the power of attorney for finances? Those things are really, really important. And I encourage and insist that my clients have those documents in place when we complete the transactions for a long-term care insurance policy.
So yeah, that's super important. The power of attorney and the health documents for that. Do you?
You know what else goes into that, Alan? Yeah, I'm sorry to interrupt, but I didn't finish that. I took a breath and forgot that I had another part to it. The other part really is to, your mom's 80 years old. Does she have, has she done any work to determine who would be a good service to have if she needs home care? There's a whole bunch of them out there, but doing some of that preliminary work and being able to, it's hard to deal with the crisis when you're in one. and having the knowledge of, what a good home care agency is, how much do they cost? What is the average age of and the experience of the caregiver who's going to be visiting the home? That's step one. Step two is, okay, we've got the nursing home, we've got the home care thing nailed down. We know the agency that we want to use if that becomes the case. When that's over, because the next logical step obviously is assisted living, or full nursing home care. I encourage my client and give them names of agencies that can show them around on video if they prefer, or in person. What do these places look like? Are they clean? Are they well staffed? Do we have specialty nursing function available to them? Are the doctors available? Those kind of details, they're hard to deal with. It's much like when you write a will and you trust, who's going to be the trustee for your children? Well, okay, that slows people down in getting those documents done, because those are hard decisions. Who's going to be the power of attorney for finances? Again, a hard decision. Who do you trust? Who's going to take care of that? And all of those things are really part of the whole planning for aging process.
Well, it sounds like, there is a lot to go. So like somebody would talk to you and get those details, like, my details and my family are going to be different than somebody else. I'm sure there's a lot of commonalities. A lot of times it's like the family takes care of the elderly parent, and but with like some home healthcare providers or nursing as well, is like something like that as well. Is there like a hybrid, or is there different ways that your insurance could offset costs that you're obviously going to have, no matter what, right?
Yeah, well, that's a good point you bring up, is what's the cost of care? The cost of care starts out with a couple of hours a day for a home care agency to come in. So maybe it's $40 an hour for a couple hours a day. And, so maybe you're talking $1,000 a month, and maybe $2,000 a month. But when that progresses and you get into assisted living and nursing home care, now you're talking real money. You're talking $100,000 a year, $10,000, $12,000 a month. 724 home care for somebody. I don't know, these numbers just, they're unbelievable, but we're talking over $20,000 a month for a 724 care at home. That's when you take the $40 an hour and you just do the math. It gets very, very expensive. And how do you deal? Where does that money come from? Well, that's the kind of problem that we solve at Essential Plans.
Okay, so let's back it up then. So, at what point should a family, at what age in like say the parent's health or parent's age, should people start looking at long-term care health insurance in order to, because you're going to get a lower premium, right?
Mm-hmm. Yeah, when you talk about insurance, this is like health insurance. Age and health status are the most critical factors. The younger you are, the two things: one, the lower the cost, and number two, the less likely you're going to have a disease that's going to cause an insurance company to say, we don't want to take this risk. Because that's really what it is. It's a risk sharing with an insurance company. So the younger people are, my clients generally, and my oldest client is 73 years old. My youngest is 36. And they're all in between. Most often the people who are referred to me are in their 50s or their 60s. And, they've had the parent and care issue. They've got their own children, and they want to do something about making sure that their children, number one, aren't burdened with the responsibility, and number two, that they've earned and saved through the lifetime of work goes for its intended purpose, not for long-term care expenses.
Right. So, so can you explain that conversation or that planning a little bit with a family? Say that they're I don't know, like a typical scenario for you. Can you kind of like paint a picture of what might be a typical scenario for you?
Well, sure. In fact, I had a phone call on Friday with a 53-year-old woman whose mother was in care, and she had her own children, and she was interested in getting some financial coverage for herself. And I said, well, what about your husband? Well, no, he's not really interested at this time, which always is, wait a minute, he's not interested. He doesn't love his family. But I don't get into that part of it. And I say, okay, if that's the way it is, we'll go with it. Well, that's a good question. There really is no typical. There's really about 6 different, if I have to call them pigeonholes, where people when they're referred to me, the adult children, their aging parents, of course, with their own children. We've talked about them. The single women with nearing or adult children, they're very interested. They don't want their sons having to give them a bath. Okay, they want to be able to pay a professional to do that. Men with younger wives, when younger, we're talking 10 years younger than they are. They recognize that if they need long-term care, the assets they've saved are going to be used up for their care, and not to go to take care of their spouse. So that's the second category. Well, what's one thing that's really interesting? A recent client was a 73-year-old woman who had considerable assets. We're talking in this $10 million range, and she was referred to me by a friend of hers who was also a property casualty agent. And I said, Norma, that wasn't her name, but Norma, you've got the money to pay for this. Why would you be interested in a long-term care policy? She says, because I want to be sure that gets taken care of without burdening anybody else. I didn't get this money by being careless or casual about things. And having a long-term care insurance policy makes sure and guarantees that the money I have is going to go for the purpose I have. She had no children, but she had a couple of charities. And she wanted to make sure that the charities were going to get all the money that she had accumulated in her lifetime. And the long-term care policy was going to assure that she was going to get the money was going to go for its intended purpose.
So in those scenarios, are you developing like a plan like for different contingencies? And how does the actual policy look for a family? And can you change it?
Yeah, well, the first thing I ask, I make sure that people understand that we're going to make this affordable. I get a lot of people say, oh, it costs too much. Oh, the rates are going to go up. And, or I'm too old, I'm too young, I'm too thin, I'm too fat. People have lots of reasons and excuses for not wanting to engage. But when they come to me, I know that they have an interest. Whoever it was that made the referral had a good reason for doing that. And once we've determined, okay, we're going to determine affordability. And that requires that, okay, I got to know about what you got for money. What do you have in the bank? What's locked up in IRAs and 401ks? What's liquid? Understanding their financial circumstances is really important in building a plan. Before that, even is determining their eligibility. And I mean, this is insurance, and you have to qualify. So we go through, okay, what kind of drugs you taking? Why are you taking these drugs? If you had any medical experiences in the last 10 years that the insurance company is going to want to know about. And we take that medical information and we submit it anonymously to appropriate insurance company to get a pre-approval. Why do we bother going through that? Because if an insurance company declines an application, that information ends up in this quiet little organization that sits out there called the Medical Information Bureau. And the MIB collects, you go to the doctor, he writes down some notes, that information ends up in the Medical Information Bureau. You get a prescription, that ends up in the MIB. You get declined for insurance, that ends up in the MIB. And if somewhere down the road you want to secure another financial transaction, that declination of insurance is in there, which could be a problem with whatever the transaction is. So, we determine finances, we determine the health status, and make sure that at least on the basis of the information they've given me, that they're going to be able to be qualified for care. So the next thing really is, okay, now let's look at your different options for coverage, because there's four different categories of insurance plans that can help people out with the expense. The first one is the traditional style contract, which is like your home insurance, your car insurance. Once you don't generally get any money back on those policies. But if you had an accident or your house burned down, the insurance company is going to pay for it. So the traditional policies are you're going to get coverage. And if you never use it, well, thank you very much. Your money is going to be used to cover somebody else's care. And then there's what's very popular these days is the so-called hybrid contracts. The hybrid contracts are really a long-term care rider on a life insurance policy. What attracts people to those contracts is it pays off no matter what. If you need long-term care, it covers those expenses. If you croak and never use a long-term care, it's going to pay off like a life insurance policy. And if you say, hey, insurance company, I got this 15 years ago, everything's changed, I don't need it anymore, and they'll give you your money back, and some of it or all of it. And so people are really attracted to that. Another style contract is a home-only policy. Generally, the home-only policies are for those who really don't qualify or have some medical condition that makes getting a real policy difficult. A home-only contract will cover home expenses. If you go into assisted living or nursing home care, all bets are off. Thank you for your premium, but there's no coverage for that. But it will cover for home care. And then there are annuities that have what they call multipliers built into them. Again, these are for people who have difficulty getting a hybrid or a traditional policy. And the way these annuities work is that it's a lump sum of single premium that goes into it. And if, in 5 years from now, it wouldn't normally pay out, let's say, $10,000 a month, the multiplier would pay $20,000 a month. And you can use that for long-term care once you've been certified as needing long-term care. So there's a whole range of financial products. Insurance companies, they've been in the business a long time. If there's a need out there for something, they will find a way to insure
it. That's a great breakdown of those types, those categories. What intrigues me is, or you might have to talk to me like I'm a 5-year-old, is how did the taxes play into this? I know we talked about this before, and we were talking about taxes, but I didn't really understand how taxes for the client work.
Okay, that's a great question. I'm glad you brought that up because that's one of my favorite subjects. First of all, when the HIPAA Act was passed in the late 90s, it included a provision for long-term care. Long-term care, tax qualified long-term care policies had some standardization within the tax code. You have to suffer at least loss of 2 activities of daily living, and it has to have inflation built into the benefit. Okay, so the HIPAA Act built in qualifiers. Every insurance policy had to be tax qualified. What it means to be tax qualified is the premium is deductible. But it depends on what your tax status is. If you're filing as an individual and you do long form, you can deduct the premium, but it's part of the 7.5% adjusted gross income for medical expenses. Medical expenses for premium or out-of-pocket expenses and long-term care premiums.
So do you have to exceed that 7.5% before you can deduct?
That's right. All those expenses built into the 7.5%. And however, almost, I would say 80%, 90% of the people I work with have a LLC, or they're self-employed, or maybe they're a part owner of a company, or maybe they're a sole proprietor, or they're a C corporation or an S corp, whatever it is. Those types of designations allow for full deduction of the premium. In most cases, there's some, tax codes are very complicated, and there are provisions in there that you have to make sure you qualify for the tax deduction. But most of the premiums for the long-term care expense premium is deductible through a business entity. Now, when the benefit comes out, It comes out tax-free. So let me see if I get this right. I can buy a long-term care policy and get a tax deduction for it. So I put in, I don't know, $10,000 a year. I'll get $500,000 worth of long-term care coverage, and that's all tax-free. So what's the underlying message here is the government, the federal government and state governments now are very interested in people building their own personal safety net, and they provide incentives through the tax code to get people to do that.
Great. That's great. I understand it now. Thank you.
Okay.
I think we covered a lot, right? Is there anything I'm forgetting?
One of the frustrating parts of this long-term care industry is getting people to be aware of the cost of aging. People are busy with their lives. They got a business they're running. They've grown a family. They're still educating themselves. They've got a lot of expenses. And, if you got growing children, you look at the college expenses, get them to say, okay, look, I've got to think about what it's going to be 30 years from now, my life. It's hard to get people to do that. And that's where my referral partners are where I can help them out, is because if somebody comes from an estate plan or is ready to do an estate plan, they're ready. Okay. They know that they've got a plan for the future. The people who are providing care services, whether it's home care or assisted living, they get an adult child come in and says, okay, here's my mom, and what's this going to cost? They're ready. They're ready to receive the message. And that's why my referral partners are so important.
So let's put that in reverse with referral partners, is that how do you help the estate attorney, the financial advisor? I'm sure that you give them leads as well, right?
Well, whenever they come across, I do a lot of marketing now, social media wise, and network meetings and so on. And I'm always looking for, I've tried real hard, and I've tried all of this year to be connected. And, I guess the first couple of years I was here, I was just trying to get to know people. And I didn't know anybody that I could refer to. But and after 4 years, and after the 2 years on a flat screen and 2 years on the road in the network meetings, I'm finally getting to the point where I can provide referrals to the people who are referring to me. And I've known for a long time that in order to get, you got to give.
And are you seeing a difference, and do you, like, if you say you have a referral for whatever category of business professional, I'm talking about estate planners, you're somebody you can refer to. It could be another insurance company, right? But do you look at all of those referrals as the same, or if you know them, do you see certain specialties that say this attorney would be better than that attorney for this client?
Yeah, well, of course. I try to, when I'm dealing with somebody who needs an estate plan, try to get a sense as to, who they are. I mean, I always, to the extent that it's possible, I try to meet all of my clients in person. I know we've got Zoom meetings, and we do a lot of transactions that way. But getting to know people face to face, it makes the referral to an estate attorney, whoever it may be, much more valid, because I'll know something about them and say, this is going to fit in good for you, Kevin, or this is going to fit in good for you, George. And I try to make an assessment. I did have a psychology course in college, but I'm not all that good at it, but I do my best.
Well, I didn't take any psychology classes, but in the amount of relationship building, networking that I've done, I've noticed that no two professionals in the same category offer the exact same service. Not all banks are the same.
Indeed.
Even photographers, videographers, they have specialties. They have, kind of personalities too that might work better for one than the other. That's why in our network, we don't have like a limit on any kind of category. It's based on, their service, their professionalism, things like that. And that's how we grow our network. But I just wanted to get your take on that kind of differentiation among referral partners. So
What's pertinent, and I know you, this is important too, is, if I'm making a referral, I want to make sure that person I'm referring, a client I'm referring to, an estate planner, a financial planner, or a property casualty guy, or whoever it may be, that person I'm referring is going to do a good job. And I've got a handful of estate planners and financial planners and service agencies and so on. But I know them because I make a point of having a cup of coffee with them, a meal, maybe a cocktail, whatever, to get to know them. So when I refer a client to them, I have a strong sense that it's going to be done right.
And just so you know, before you have that coffee meeting with them, any referrals or introductions that come from us, we actually send them the clips of your interviews with me, the video, this podcast, so that they can get an understanding of you. So they have more information about you, so your meeting is more productive. That's part of our service. So hopefully we can save you time there.
Well, we can do the same to you.
Yeah, and vice versa. Our website is growing list of a knowledge base of all the professionals, and it'll save you time checking out that website.
I've done that
before you meet with them. Oh, good. So,
yeah.
I'm glad. I think we've covered a lot. I think people have enough information, and we'll show them how to reach out to you. Your website has a lot of good information and videos and testimonials about your services. But I think, they need to call you, right? They need to really talk with you and bare their souls.
Yeah, they do, actually. One other point too that you might want to put on here is that I touched on HIPAA and what the federal government and state governments are doing to try to encourage people to build their own personal safety net. That initiative is becoming very strong on a state level. A couple of years ago, the state of Washington passed a payroll tax that requires any W-2 employee to put 5.85% of their income into a fund that will help pay for some of their long-term care expenses when the time comes. California is on the verge of introducing legislation to do the same thing, somewhat different than what Washington State did. The good news is that California learned from the mistakes of Washington. And come January, there'll be a bill introduced that will do essentially the same thing. It's going to apply a payroll tax for every W-2 or K-1 employee to pay into this long-term care fund. There will be exemptions. You'll be able to opt out if you're a low earner. You'll be able to opt out if your income is over $400,000. And you'll be able to opt out if you already own a long-term care policy. Again, there's an incentive here to encourage people to take care of themselves. But this is being driven by the fact that, in California, in 6.5 years, in 2030, 11.5 million people in California will be over 65 years old. What is Medi-Cal going to do with all of these people? They're already broke. And now we're going to have an influx of people who don't take care of themselves, don't have a long-term care policy, and come into the state to fund for their long-term care expenses. And so my expectation is after the first of the year, once the media gets hold of the fact that there's another tax being applied for in California with an opt-out option if they own their own policy, that's going to have a real create a lot of incentive for people to take care of themselves and not rely on the state. Because what's the state service is going to be? If you say, okay, well, I don't care about that, I'll let the state take care of me. Well, remember, the state is going to be the provider of services, and they're going to tell you where you get your care. You need physical therapy, you may have to go to Hemet for physical therapy, or you may have to go to I don't know my way around California. You may have to go to San Diego for particular services or somewhere else. People who are going to rely on the state to take care of these services I think are going to be disappointed.
So your insurance really has nothing to do with that. You're like the better alternative to that type of client, right?
It will be the alternative to relying on the state for your medical care when you get older. Yeah.
Okay. But you obviously know the what's down the road, and we can reach out to you as these laws take effect and these taxes come into effect.
Well, that's what I've been branding myself as somebody who can help with those problems since I got here 4 years ago. And you know, I thought it was going to take 5 years to be able to establish that brand, but you know, it's happening. It's beginning to happen now.
Do you offer any free consulting or special offers if people want more information about how to work with you?
Sure, everything that I say is free to the consumer. 90% of what I do is educating people. How do I get paid? Insurance companies pay a commission when somebody buys an insurance policy, and that's where if there's a source of income, there where it comes from. Now that said, when I left Massachusetts, it was after 25 years of building a successful agency back there, and God bless those people. I've got some 20-year employees, and they run the agency quite well. When I told them I was going to be moving to California, they said, you know, not bad, Jim, good, because I think the place runs better without you. We'll call you when we need you, and we'll send you money. So when I talk to people about long-term care insurance, it's not because there's a commission behind it. It's because I really believe that this is an essential tool for the well-being of families.
Okay. And like, do you have any like checklists or reference guides that might help people in preparing to talk with you, or, you know, anything to guide them as maybe even a conversation with a family member?
We've made up and keep updating it. I want to say it's a 1-page frequently asked questions document, but it's turned into 3 pages now. So whenever I talk to anybody, on the first basis, we do 2 things. One, we show them that we provide them with that frequently asked question sheet, which goes into all the things that we've talked about here, Ellen. And then we also show them the chart that what the cost of care is in a given setting for every given zip code.
Okay. Well, I want to thank you for your time today. Look forward to working with you as a Power Partner USA member, introducing you to our network and promoting you outside our network.
Well, I really enjoy this. There's nothing like better than talking about this stuff, Alan. And, you know, it's age appropriate for me, number one, and number two, really because of my family experience and because I know what the value of insurance is. It's about lifestyle. It's about family protection, and it's about well-being. That's what drives me.
I agree. Thank you. I agree. Yeah, thank you for that.